Hi guys, my name is Pafode. I'm back again on my real estate channel called Papa's Real Estate. I'm here to talk about real estate in any form or shape. That's what we do every week. Bring you an episode or two to talk about real estate. Again, please don't forget to like, subscribe my videos, share, comment below. Let me know what you want to see in the future, what types of topics you want me to cover regarding real estate. Today we can talk about the types of loans you can use for purchasing real estate, either for yourself to live in there or for a kind of a house to either fix up, rent it out, or fix up and flip it or anything like that. So we're talking about the types of loans you can use. We can break real estate down into two aspects first, but we can talk about the one aspect. And those two aspects are, you have the residential real estate and then you have the commercial real estate. So we're here to talk about the residential real estate. And when we say residential real estate, we're talking about one single house, a duplex, 2 units, triplex, 3 units, or a fourplex, 4 units. Those are the easiest type of real estates to buy as a beginner, because of the availability of the type of loans and the amount of money you need to come out of pocket to be able to get those kind of houses. And then we're not going to talk about the other residential part of real estate, which is the multi-family of like commercial side, which is like 5 units or more, apartment buildings and stuff like that. We're not going to talk about those. What we're going to talk about is one single family unit up to a fourplex, because with this type of loans you can have, with this type of houses actually, you can have access to loans that are mostly backed by the government, and they're easier to get into in terms of down payment money and requirements and stuff like that. First of all, we can talk about FHA loan, Federal Housing Authority. This is a loan that is available to anybody in the United States, mostly to buy a house, and you just have to come out of pocket with 3.5% down payment for the house, and then buy it, and the government will guarantee the 96.5%, and then your closing costs and stuff like that. That is for the FHA loan. There is another type of FHA loan called the FHA 203K loan, and this type you're also required to come out of pocket with the same slower down payment, which is 3.5%, but it's for houses that need work to be fixed up. Then you can buy it with the FHA 203K loan. They will cover up, Federal Housing Authority FHA loan will cover up your purchase and the fixing up cost for the house, as long as you're going to live in that house for a year. Same as the FHA regular loan, you have to live in the house for a year. But the FHA 203K loan, they will cover up your cost to fix up the house up to 30K, and you can do this while you live in the house. And then when you're done, you can continue living it for a year, and after a year you can decide if you want to stay there, sell it, refinance it to a conventional loan if you have enough equity, meaning loan pay down minus how much you owe or how much the house is worth. You can do that. And then if you have this, you can only have one of these at a time. So if you want, you can use it once, and then when the year also comes, if you have value goes up or you pay down the mortgage up to you owe only 80% of the loan value, you can refinance and get out of it and go to a conventional loan. And if you want to move, you can do the FHA loan all over again. Then the conventional loan is the one that you have to come up with a bigger down payment. Sometimes 10, 15%, 20%, but mostly 20%, 25% is the most common you will see. If you come out of pocket with less than 15%, then you have to pay for PMI. The higher amount of money you put down, closer to 20%, the less they charge you for the PMI, which is the private mortgage insurance. So after you do this, then you can just get rid of that PMI later. If your loan is paid down to 80% of the house value, or the value of the house went up, you can get rid of the PMI by refinancing. Then we have this almighty VA loan, and the VA loan is meant for the people that serve in the U.S. military. It doesn't matter which branch you served in, and it's a way of a government saying you thank you for your service, and will make home ownership a dream come true for you. And I would also say thank you for your service. Anyway, this VA loan, you can get a VA loan with zero out of pocket. You can buy a house with no money out of your pocket because it's a zero down payment. But it's for the military people that serve in the military for 5-6 years or longer. Then how it works is you can even put the closing cost in the loan or ask the seller to pay for your closing cost by sometimes even paying them few $1,000 higher than what they're asking for if the house appraised for that amount. So the VA loan, you can also use it over and over again if you can refinance out of it and go into a conventional loan after you own the house for a year. And VA have a cap, maximum amount you can use, but they based it on the area you live in and how much the houses are worth in that area. So the average amount of house is what they go by. If you use some of it, you didn't use the whole cap. If you move somewhere cheaper or however the area is average, you can use it again to finish up the rest of the balance you have. Let's say a VA loan caps you at $700,000. Then you buy a house for $300,000, you live in it, you get stationed somewhere else, or you get moved. You can use the VA loan again as long as the other house you're buying is going to be less than $400,000 because the total can't be more than $700,000, for example. But it depends on the area you're buying that house at, meaning that the area you live in will determine how much the cap is for that VA loan. So for those people in the military out there, this is a perfect way to get a house, and I think it's the best one. Then from there, you have the USDA loan, United States Department of Agriculture. They gave loans to people that live in rural areas. And you will be surprised during their looking at their map what they consider rural. You might be living in a place that you think is suburbs, but they consider it rural. As a rural area, they will let you buy a house using a USDA loan, and that will be another 3.5% down payment for a house that is even bigger, or an agricultural product if you're into farming or any other type of stuff. Then after that, you have hard money loan. Hard money loan is a private companies, individuals that do it, and they will like if you can't qualify for a regular loan from the bank, these people will give you a loan, but they will charge you a higher interest. Some people will do interest only for a year or two. Then from there, you can refinance out of it by fixing up your credit and all that stuff. It's kind of expensive to get into, and the down payment requirements are different because it's private. It's not regulated by the banks or the government, so it's individuals doing it as a business. So you start to know what to get to and how to go about it. And from there, you can also buy a house if you talk to the owner of a house who own a house. They either don't have a mortgage on it, they want to sell it for one reason or the other, they don't need the money or want the whole chunk right now. They can have you buy their house and they will act like the bank. So you make your monthly payments to them. But how it works is you have to include a title company or a lawyer or somebody to do the closing so that you can take title to the house, meaning the deed to the house. This can be done in two ways: by a closing company that's called escrow company, or with what you call a lawyer in some parts of the United States. But it can be done if the person owns the home free and clear, but you can also do it if they still have a loan on the house. But that part is a little tricky because there's this thing on FHA and conventional loan called due on sale clause. And due on sale clause means that if you change title to a house without paying off the existing mortgage, the bank can give you 30 days or whatever and say, hey, you need to pay off the house, the balance you owe us, or we can foreclose on you, whatever the case is. It doesn't really happen, but that doesn't mean that it's not going to happen to you. So if you got to get into it, you have to know those risks if there's an existing loan on the mortgage. If there's no loan on the house, actually there's an existing loan on the house, but if there's no loan on the house, then it's up to the owner. Some people try to avoid paying a chunk of taxes, so they try to do all that stuff. So that owner financing, or you can just assume the person's mortgage, the existing one, just like I said. And then with that, they can see how much they want you to pay monthly and how much interest they want to charge you and all that stuff. It's negotiable. Then you go to the the construction loan. How construction loan works is you can consider it as two parts, but actually it's not two parts. It's a construction loan, it's a construction loan, but you can break it into two. One, if you own a land and you own the land free and clear, meaning there is no loan on it, you can go to the bank and say, hey, Mr. Banker, I have this land located on XYZ place. I wanted to build a house on it, but the land is worth X amount of money, let's say $100,000, and I need $300,000 to build a house. The bank can say, okay, we don't need you to come out of pocket with any money. Actually, we can use the land as the collateral, meaning guarantee, to give you a loan to build a house. So they will do it as, okay, here's the money to build a house, but it has to go through escrow. And as you build, you take money out of it and put it into the house. And whatever money you take, you pay interest on that. When the house is complete, they come and look at it, do inspection and say it's complete. Then your mortgage automatically starts, or you refinance it. That's because you own the land, you don't come out of pocket. But if you don't own the land, you have a loan on the land, making a mortgage payment on the land, then they will make you come up with a down payment, which can be 20% or 25% of what it's going to cost to build the house. So you can look at it. If you own it free and clear, it's easier to do it. But if you don't own it free and clear, then you have to come up with that 20% down or 25% down. Then from there to the rest of the world, or even in the United States, about 35-40% of homes in the United States don't have any mortgage on them. So those are people that either bought their houses cash, or they paid off the loan. So then they pay it off and they don't have any mortgage. So if you have enough money saved up the bank, or you get a rich uncle, or you get other means of getting money, you can buy the house free and clear with no mortgage on it. And when we live in the United States, when we say cash, we don't just mean that you get a duffel bag full of cash and carry it around to the owner and give it to them. No, you still have to go through a lawyer or through an escrow company to do closing, which is the safest way to do it. You do not want to give anybody money if you don't go through a company to be the mediator, just in case if something goes wrong. These are the types of loans and ways to buy a house. I mean, there's plenty of ways you can buy a house. I can't cover all of them in this short video, but I'll come up with more videos about how to buy a house in the future. But the basic point is, if you don't have money to buy a house cash, but you wanted to buy it in other means, the first thing you should start with is to work on your credit score. The lower your credit score, the riskier you are as a buyer, and then the riskier you are, then the higher your interest rate. If you have a good credit score, 740 and higher, you will typically get the best interest rate possible. If your credit score is less than 740, your interest rate would be higher. And if it's so low, in the 500, sometimes you may not get a loan. 590, 620, you will get a loan from 620 easier, but you get a higher interest rate. But if your credit score is higher, then your interest rate will be lower and it's easier for you to get a loan. So if you always think about buying a house, always look at your credit score, work on your credit score, get it higher, and then from there, work with a loan officer to see what you can qualify for, how much you can afford, your debt to income ratio, meaning the money you make, how much of it do you use to pay off your other debts, and how much percentage is left for you. And basically less than 50% is always better. The lower the percentage of your money goes out to bills, the better you are with a good credit score. So again, please don't forget to like, subscribe, share the videos, and there'll be more coming on the way regarding this topic or other topics in real estate. So I'll see you back soon on my channel, and looking forward to seeing you again. Thanks, bye.